So that is another one to keep on the radar. For now, we've got, 80, 85 points on the Nifty with a pretty strong kind of start at this stage. Well, Sanjeev Prasad is the market master of the day, managing director and co-head Kotak Institutional Equities. Sanjeev, great to have you with us here. Thank you very much for your time. You're calling for some consolidation, right? So the market spends some time digesting all that it has done in 2022, one of which, of course, is pulling valuations also, in some cases, way above last 10-year, 15-year averages. Go on.
Yeah, true. See, the market hasn't done much in 2022 also. So last 15 months, if you take, let's say, from September end of 2021, it's been pretty much in that 18,000 plus minus range only, barring a bigger correction in May and June. People are obviously very worried about high inflation and high interest rates and so on and so forth. So market is, as of now, in a consolidation phase. Valuations are rich. And the second thing which we have to figure out is, how long do the central banks, including the RBI, hold interest rates? So as of now, we're getting some comfort on the fact that inflation seems to have peaked in some countries, peaking in others. So hopefully, as far as the actual central banks are concerned, we are probably reaching terminal or peak rates as far as the current monetary cycle is concerned. Look at specifically for India, policy rate 6.25 can head to 6.5, but hopefully that's about it. Barring any negative surprises on inflation linked to food or fuel going forward. A bigger question is, how long do central banks hold rates now once they take it up to whatever is the peak levels for the major economies that matter? And that's where the debate is going to be, over the next few months between the market and the central bank. Obviously the market would like a quick pivot from central banks. As of now, all the indications from central banks is that they're going to hold interest rates for a longish period of time. And I guess that's probably going to be the case given two factors. One is central banks obviously want to maintain credibility, given the fact they lost some of it in the run-up in inflation and they were caught napping. So this time around, they would want to see inflation actually coming off significantly. And more importantly, core inflation starting to come off. If you look at the data for core inflation in most countries, it's still very high and not coming down. So that's the other thing which we want to see, whether you are starting to see some demand destruction, particularly the US, which would result in weaker bargaining power as far as the employees and wages, etc., is concerned. So those are two things which I have to wait for. I think market has already factored in the fact that we are at peak inflation and interest rates. But what is probably not factored in Indian valuation, at least, is the fact that interest rate could sustain at a high rate for a longer period of time. So obviously, consolidation would hopefully result in earnings numbers. As we roll over earning numbers, the valuation is starting to look more reasonable, at least for the growth/quality part of the market.
Just wanted to bring your attention to a lot of these diagnostic stocks. Of course, we mentioned them briefly, but they are in focus. Metropolis as well as Dr. Lal Path Labs, as because of the COVID scare globally, the Union Health Minister will be chairing a high-level meeting today, as cases have jumped globally. And earlier in the day, the Health Ministry wrote to several states and union territories to ramp up genome sequencing to detect any new variants of COVID. So it's unfortunate that it's happening again, but of course it means more business perhaps for a lot of these diagnostic companies. Sanjeev, this is another overarching worry, right? With what's happening in China as the COVID cases are rising, there's going to be several ramifications on global markets, whether it's on manufacturing, whether it's supply chain constraints. Now, of course, what's happening with ramping up on the health side. What do you do here? How do you A, play this theme as an investor, and B, do you raise your cash levels just fearing that there could be some pullout because of this?
So, China obviously will have to wait and see what eventually transpires over there. So currently, the market is looking at a reopening. But obviously, number of cases have gone up quite significantly. So I don't know what response should we expect from, the Chinese government now. So they seem to be starting to, relax the controls on COVID. Number of cases are going up. So I don't know whether you see a swifter, response in the form of lockdowns once again and so on and so forth, which have obviously, as you rightly said, a lot of negative implications for manufacturing and global good inflation and so on and so forth. It's really confusing, to be honest with you, because these things are so diametrically opposite. Reopening versus lockdowns. Implications are so 180-degree apart, right? So I don't know what to really make out of of this whole COVID scare in China for the time being. If you take a longer term view, and obviously, China has been preparing for reopening in the sense, trying to ramp up vaccinations for the more vulnerable sections of the population, increase the number of hospital facilities and intensive care units and so on and so forth. Now, whether that is sufficient for the Chinese government to be comfortable about continuing the reopening policy, we'll have to wait and see. So this volatility will continue in terms of the news flow to China. And as I said earlier, the implications are pretty much 180-degree apart from reopening to, in a way, closing once again. So honestly, I don't know whether we can do much in terms of, trying to, put in any coherent strategy in response to whatever is happening in China currently.
All right. Hi, Sanjeev. Good morning. Sanjeev, on PSU banks, investors who have got in at the right time, well, they are in a bit of an issue because they are wondering whether or not they should book out. And the other side is valuations are still a little bit comfortable. What's your sense on the PSU banking index? Is the best behind them in terms of getting in, or do you think they still give you some kind of cushion on valuations so you can still get in?
Yeah, so I think valuations are still pretty reasonable for most of the PSU banks. If you look at, let's say, something like Canara or a Union Bank, they are still at about 0.8 times March 24 price to book, and their ROE, at least over the next 2 years, will actually go back to 13 to 15% level. So at least one time book, you can argue, on a more short-term basis. Obviously, investors who have some sort of a medium-term memory of PSU banks obviously are not going to be comfortable with many valuations which are above one-time price to book. So that's probably what you hope for. Some relating to one is possible in the context of the fact that at least over the next 2 years, you are not going to see any challenges on credit cost. Credit growth is recovering. So if I put those two together, I don't see too much negative news out there. Also, PSU banks are fairly comfortable on credit deposit ratio and all that stuff. So I don't see too much of an issue as far as NIM is concerned for some of the PSU banks also. So all put together, I think people who are invested in can stay invested. And obviously, these banks will also generate some, profits in terms of, book value will also increase over time, given the fact that they're finally generating, some reasonable amount of ROE, 15%, whatever is the compounding that you are seeing on the book. So if you put, some growth in the book itself over the next 1.5 to 2 years, plus some possible rating, I think it's a decent rate to be in.
Yeah, no, absolutely. Sanjeev, as we get into 23 do you think the focus and maybe money will perhaps be made in underperforming sectors? Basically IT and pharma, which are the two large sectors which have done very, very badly. What's your sense?
Seems tricky on current form, given the fact that, at least Europe is, going through a massive slowdown and probably will get into a recession also. If you look at the US, I suspect the central bank over there, that is the US Fed, will probably continue to have a fairly tight monetary policy, at least for the next 9 months or so, which means they will probably like to engineer a slowdown and, if not an outright recession, to bring down, core inflation and break the bargaining power of employees over there. So basically, that means you need to see an increase in unemployment levels, which are currently at 3.7%. If you look at the non-farm payroll addition in the US, that is still very, very strong at about 250,000 plus last couple of months. So clearly, we're not gone to a stage, where US is starting to feel the effects of the higher interest rates and so on and so forth, which means the central bank will have no option but to keep interest rates higher for a longer period of time to actually break down inflation expectation and particularly core inflation. So in that context, I would assume if you're looking at a slowdown in the US posed by the actual central banks, I suspect IT demand is not going to be strong, particularly the discretionary part of demand from customers. Pharma, honestly, you have to look at on a more bottom-up basis. They have their own challenges. Many of them, US generic pricing, clearly there is no pricing power. You can make some money as long as you have a new product launch for it and you have some exclusivity around it, but that's about it. So, the stocks which you like in the pharma sector, more the domestic oriented stocks, because you are seeing decent amount of growth over there. Most of the at least the domestic part of the pharma company, that seems to be growing at about 11%, which is actually quite decent. And that's probably the business which we are much more excited about currently.
Okay, all right. Thank you so much, Sanjeev, for stopping by and giving us a view on the markets. Wishing you a good festive season. That's the end of 2022. And looking forward to having a chat with you in 2023 as well.
Bye.
Well, time to move on then. We have Mr. Rajiv Lokchan, the MD of Sundaram Finance, who's standing by to run us through how business outlook is shaping up, as well as how is he reading the current scenario. Hi, sir. Morning. Thanks so much for joining in. Well,